Now, do you believe a weak dollar is a friend of the stock market?
It should be, but given this current situation, the dollar is not doing what the Fed would like it to do. I mean, the euro has dropped to, I guess, almost 20% against the dollar, and as you mentioned before, these companies are stumbling. Our countries are not doing extremely well. I don't think they're going to go down. They're having major recessions, but we seem as badly as as growth is here, or we think we'd like it much faster. It's better than abroad. And I think our banking situation has been handled, maybe not in any optimal way. I think far from optimally, but it's been handled better than the euro. So I think the United States might be a place to be.
Financials like Hartford, do you still like that, or?
Well, I do like Hartford. I think Hartford just lost a lot of its capital on the subprime fiasco. But it's got really very good earnings power, and I like the stock. They have a preferred out that's a convertible preferred, but unlike that we call in a couple of years, but it's yielding close to 10%.
And oil and gas, oil is going up again, even though inventories are out there. Which ones do you like? And you said recently, I think, that the integrated ones, like an Exxon, you feel there are better values out there. So first, let's do the oils and the gas.
Right. Well, actually the Exxons and the Chevrons and the Conocos, they're good companies. They'll make reasonable money, and they're excellent blue chips to hold. I think if there's higher inflation, and also the fact that we've used more oil than we've discovered in every year since 1982, with the exception of 2009, and then we were maybe 0.5% below what we used in 2008. So I think that oil is really not in short supply, but its demand is still there, and we have some excellent exploration development companies. They also own gas, we can go into later, but they have major oil reserves. Apache, Anadarko, Devon would be three that I'd look at. And
Dominion?
Dominion, I guess we probably, if we...
Chesapeake, do you like that?
Chesapeake, yeah, Chesapeake we do own. I'm talking about stocks we own now. We have to keep only a certain. We can't go beyond. We're high in oil, and we would look at it.
Do you still have BP?
We have a little BP.
That's an example of your contrarian investing. You bought it when everyone else is fleeing the exits.
Yes, actually, that and Anadarko, because Anadarko was I guess they had a 25% interest in that well. And Anadarko's come back beautifully.
Getting to psychology, what you call cognitive psychology, what are the factors that you discuss in the book? I think you've mentioned in the past Morningstar, that if you get a lot of stars from them, be careful. They're looking at the past, not the future.
Well, with all due respect to Morningstar, a lot of the consultants also have rear view mirrors, and they're looking at these very carefully. And I guess what we've got in the book on that is that a lot of our risk measurements simply like the beta has never worked. We all use it. Every consultant uses it, but even the efficient market people have given it up. Fama and French, who are two of the leaders in efficient market thinking, particularly Eugene Fama, wrote a paper in 1992 that refuting Nobel Prize winner Bill Sharp, who came up with beta, saying that it doesn't work, and so they're out looking for a new beta. I guess my question is, if they're looking for a new one, how are markets efficient for the last 40 years? They use beta.
One thing on psychology, which we've always known, is that every investor says they're long-term,
Yes.
and they are until the market takes a hit.
Yes.
You showed your fortitude by taking a huge hit in 08, 09, clients fleeing for the exits and the like, even though you came back in the latter part of 09.
Yes.
How do you how do you guard against the crowd reaction?
Well, as a money manager, it's very tough. The doing the right thing for your clients will often result in them leaving you for a while. We had that happen to us during the internet bubble, where we wouldn't buy internet stocks, and even some of our value competitors bought them. And we called into meetings, and the executive committees would say to us, "Well, look, it's not that you're doing badly overall. You're trailing the market overall, but you're trailing your competitors." And we'd say yes, but they're loaded with these tech stocks. And then it hurt us. But then when the market turned the next year, I think one of our funds was up 43%, our major fund, when the market was down 10. And so a lot of the business came back and actually went up sharply from there. But psychology has a very major role, because it's only, I think, some of the new work, although there's been a Nobel Prize awarded with this work already to Danica Hahnemann and another to Vernon Smith. We're just starting to find out what causes bubbles. There weren't good answers until the last 10 or 15 years, and it's just basically, again, the more we love companies, the more we're willing to pay for them. And I guess there's a corollary to that, and that is that the more we like a company, the less risky we think they are. So in the internet bubble, we would have loved these companies because we thought that a Yahoo had no risk to it, although it did go down slightly, something like 95% to the bottom before coming back. And so there are rules here, I guess, that the contrarian strategy will help you with, and that is they'll keep you out of these stocks. You'll probably lose a lot of friends in the interim and be very upset by missing these gains, but the gains are very, very short term, and the endings are never very happy.
Let's close on discussing your less than enthusiasm for high frequency trading. You shy away from the word manipulation, but you make the point politely that these folks accentuate the upside and accentuate the downside.
Yes.
And they make up now 2/3 of the volume, daily average trading volume on the bourses around the world.
They're 55 to 65% on average, and in the August, September period, they might have been as much as 80%, 85% of trading. They do perform some functions as market makers, but they also, if a stock is moving down sharply, they'll pile in, and they have what they call stuff bids, which makes it appear after they've taken a short position that they could put a bid in for 4/1000ths of a second, so nobody can really, or a short in for 4/1000ths of a second, and offer to short, say, $100 million. And by the time, between the time you move your hand to buy and you try to execute the order, it's gone. So there's a lot of that, and the profits were enormous for these people. They don't hold stocks. They probably want to close out every night.
Would you call them vulture investors?
I would, but they'd certainly disagree with this. But I think they really are very dangerous for the average investor, because they scare both professionals and amateurs out of the market. And we've just seen these enormous, mutual fund redemptions because of them. I think they all seem to trade in packs. Now it's maybe pure chance. I don't know. When one sells, another will sell, almost instantaneously. And so they, as you said, Steve, they accentuate the downturns. And similarly, if the Dow rises 100, 150 points, they'll be very, very long.
Now, you suggest to investors in this kind of environment, don't get out of the market, but you first say don't do stop-loss orders. That
Yeah.
doesn't work anymore.
Yes.
And you also suggest exchange-traded funds as a way to protect yourself. Can you first discuss why we shouldn't do the old traditional stop-loss orders?
Well, stop-loss orders were always good, but if the liquidity in one of these downturns where you have 85% of the trading going one way can take we saw that with the May 6th 2010 crash.
Flash crash.
The flash crash, yeah. Some stocks were down as much as 65%, 70% or more, and it wasn't a few; it was dozens and dozens. And so the exchanges stopped that, but they repaid those people. But a lot of stocks were down 50%, and really, there was just absolute panic, and liquidity totally dried up. So it's a stop loss. Well, when you put it in, if say your stock was 50, and you put a loss, sell it at 49 and 7/8 or better, you won't be hurt, or people won't be hurt by it. So that stop. I think in this kind of highly volatile or market, you probably want stop loss orders on the one side, and you also want orders that limit the price that can be bought. Stock can be bought on the other.
So you still like stop-loss orders? Does it still work in this crazy environment?
I think it keeps you out of the craziness, because the high frequency traders are not going to keep these positions. They're not going to drive the market for more than that day. And even I think in that flash crash, slowing down a little bit, which they did do, slowing the trading down, saw it peter out, or the buying came in, and market came back pretty sharply.
And why ETFs?
Well, I like exchange traded funds because with this enormous volatility, they give you more diversification. So if I were going to buy, say, exploration development companies, one ETF will give me or give us every exploration development company in the S&P equally or market weighted, and so we're getting a good diversified portfolio, and rather than having a portfolio that has a few stocks that just may have chance negative events.
What do you feel should be done? Because if you put a tax on these things, they're just going to go offshore.
Well, I think the tax would since they trade off in more normal markets, they trade for a fraction of a penny. I guess there's one house that even has barrels of pennies at its headquarters to show that that's what they make, but they do so much volume but that would really take the profit margins out of this. And the average investor wants low liquidity. Like the VIX was 18 in July, the volatility index, and it got up in August to 44, so it was enormous. And I think this would limit this kind of trading, which is really not good for the average investor. It's not good for the institutional investor.
But would it stop the trading, or would they just do it from Bermuda?
Well, that's interesting. They'd still have to trade. I'm certainly not an expert in how that would work, but they would have to trade on an American exchange or a European exchange, and there's probably a way of taxing each trade in any case.
But the bottom line is, for all of this, investors, if they just hunker down and either get in the market or stay in the market, you think we're in for another post-82 kind of world, or at least
Well,
post-82 world?
I
Big
think
gains coming.
I think so. I think our companies have rarely been in as good shape financially, and earnings are good. If they take a slight dip, it's not going to. The stocks are still relatively cheap, and I guess whatever the tranquilizer one needs for the market, whether it's Valium or there's something far advanced, you might just, your stomach might turn over a bit more. But I think this is a place that the market is a place to be. With inflation, the possibility of inflation 4 or 5 years out, I think the bond market, particularly the long-term part of the bond market, is about the last place I'd want to be.
Well, David, thank you. And the book is again Contrarian Investment Strategies: The Psychological Edge. Thank you.
Thank you very much for having me, Steve.
Thank you.